Welcome back to the Bitcoin Layer. I'm Nick Bhatia once again with my associate Demian Schott. Today we're here to talk about Bitcoin's strength. Bitcoin trading near all-time highs on June 10th, Tuesday here when we're recording. And Demian and I want to discuss some of these underpinning fundamentals to Bitcoin's market strength, among other global macro topics, of course. Demian, what's up? What's your first question?
Yes, this whole bull run's had a theme of institutional adoption. So I'm really wondering about strategy, formerly MicroStrategy. Their credit spreads have tightened. So I'm wondering, what does this mean about how the market views Bitcoin-backed debt right now?
It's a good question. So we have to be specific about some of these new instruments that are coming onto the market with yield. Anything with yield can be compared to US Treasury yields. And from that comparison, we get what is called a credit spread or a spread of sorts. Now, when we're looking at these spreads of credit instruments to Treasury yields, what we're looking at is a relative creditworthiness. And so when spreads decline, it means that those instruments are getting more creditworthy in the eyes of the investors. Spreads decline means that the premium that one demands, in addition to the risk-free yield, which in fixed income speak is US Treasuries, that premium declines, meaning I don't think there's as much of a charge today versus yesterday of lending money or investing capital in a capital structure with this particular credit issuer. So from that perspective, Demian, credit spreads are an important metric to look at when thinking about the strength, the creditworthiness of the underlying company or that particular instrument within the capital stack of the company, because we know that it's not just the company issuer. It's also the language of that particular security in relation to the other securities. Strategy has common equity, and it has now several tranches is the technical name for it. Tranche is simply the French word for slice. You have slices of the capital stack that pay different yields. Some of them are guaranteed dividends. Some of them have non-guaranteed cash flows, and the common equity, of course, without those associated cash flows at the moment. So your question about credit spreads for strategy declining is a good one because the market is telling us right now that yes, these instruments that started at a certain spread over treasuries, that spread is declining. That is a favorable move ascribed from the market. Now, the analyst in me wants to say, wait a second, let's not just put a bunch of positive accolades on these instruments right away just because the spreads have declined. And why do I say that? Number one reason is that the world of Bitcoin corporate treasury strategies has just been born. The exception to that statement is Strategy, formerly MicroStrategy. They were the pioneer, and they came onto the market a few years ago and started stacking hard. They were a lone wolf for years, Demian. A lone wolf for years. Now they are considered the pioneer of an enormous wave of adoption. I see here in your notes that you have the tally at 126 companies, and that's publicly traded. And that's based on your research that you've done here for us at the Bitcoin Layer. So 126 public companies started by one lone wolf. And now that's why they're no longer the lone wolf. They're a pioneer in a sea of companies. So the number one reason that I don't want to give the credit spread compression so many accolades itself is that, hey, look at strategy and how far ahead of the market they have been, and to expect them to hit the market with securities that perform well should be, I think, a default approach. Said otherwise, if strategy is introducing new securities, new structures, those securities will have two characteristics to me. Number one, they will be well designed. I say that based on understanding that to be this pioneer, you have to be good at it. And they have been very good. Is Bitcoin's next parabolic move starting already? I want you guys to go check out this report at unchained.com/TBL about liquidity. Now, it uses a slightly different methodology than we do at TBL, but I really think that you guys would benefit from checking out this report and understanding Bitcoin's relationship with liquidity. Unchained and TechDev break it down in a new report. Visit unchained.com/TBL to get that report right now. Blockstream Jade Plus is the easiest, most secure way to protect your Bitcoin. Perfect for beginners and pros alike. With a sleek design, simple setup, step-by-step instructions, you'll be securing your Bitcoin in just minutes. Seamlessly pair with the Blockstream Green app on mobile or desktop for smooth onboarding. And if you want more security, Jade Plus supports multi-sig wallets with apps like Blockstream Green, Electrum, Sparrow, and Spectre. Protect your Bitcoin, sleep better, and stack harder. Use code TBL for 10% off. Go to store.blockstream.com. Use code TBL for 10% off. The Financial Freedom Report is a free weekly newsletter from the Human Rights Foundation. It tracks how authoritarian regimes are weaponizing money to control their populations and suppress dissent. It also spotlights how technologies like Bitcoin are helping everyday people reclaim their financial independence and freedom. A one-of-a-kind newsletter connecting the dots between financial repression, geopolitics, and emerging technology. Smart macro analysts don't just watch the Fed, they watch the world. Go to financialfreedomreport.org to sign up for the free newsletter. Our fantastic research analyst, Johan Bergman, who has been writing a lot of great analysis about corporate treasury strategies for Bitcoin companies, or these companies turned into Bitcoin treasury strategy companies. You guys can go check out Johan's fantastic research at thebitcoinlayer.com/subscribe to become a pro today. Johan has been explaining that, hey, there will be winners and losers. There will be companies that are very good at this, and there will be companies that are not good at it. There's also the component here to the underlying cash flow of a company. So, from my understanding, and talks with people that work at these companies, the cash flows that underpin Strategy's software business, legacy software business, and the cash flows that underpin Metaplanet's legacy hotel business are essential in building an array of tranches that then use capital to allocate to a Bitcoin treasury strategy. So the two characteristics here of why we expect strategies issuances to perform well. Number one, they are good at it and have proven it, so the market will probably rate future introductions as likely to perform well. That's number one. And number two is that these instruments will attain flow. And and our viewers and listeners, that flow is what moves the price up. When capital comes into an asset, that is new demand, and unless there is a way to explicitly increase the price at that moment in time, the price of the underlying will go up. So Bitcoin performs well as these new entrants come in because you have new demand, you have flow. The instruments themselves will perform well if they are not oversupplied, right? If they are oversupplied to the market, then the price equilibrium or the equilibrium of that price will fall, right? More supply onto the market. And you just, do your Econ 101 supply and demand graphs. Yes, as the supply increases, the price will fall. So that's why some of these companies will be good at their strategies and some will not, because some will hit the market with too much supply. See, there's pent-up demand for Bitcoin associated traditional financial products. Securities with yields, Damian, that's your question here. Hey, there's securities now with yield. The underlying support for the yield is Bitcoin price appreciation, to be very frank. And if that Bitcoin price appreciation is coupled with too much additional supply of that capital structure, you're going to dilute how well that instrument is going to necessarily perform. So, to answer your question simply, strategies, credit spreads coming down relative to treasuries, it's a good thing, but it's something that I would expect because they are the OG, number one. And number two, the fact that they are good at their job means that they are guaranteed to have inflows to these capital market securities. The yield going down is, to me, simply an expression that there's more buyers than there is supply, meaning the order books are full, right? There's more demand than supply. Basic Econ 101. That's why the credit spread is coming down. But let's look at others as they come to market and see if they are also performing. Then you can just, if they all perform well, then you can just say, hey, there's just too much demand for traditional securities that are associated with Bitcoin price appreciation. And most of the companies that come to the market, as long as they're not going to be egregious, are going to, find a way to attract capital. But we don't necessarily believe that. We do believe that the adoption wave from these companies will on the aggregate bring demand to Bitcoin and help support the market and a higher price. But that doesn't mean everybody with this strategy will be a winner. In fact, they can't, because just the law of numbers says that, some will not gain as much trust as others, right? And so they won't get that flow.
So company by company basis is
It has to
you're
be.
looking at. Okay.
But, when we think about also, let's say, oil companies, we look at oil credit and we look at Chevron debt and Shell debt and British Petroleum and Total, and we look at all these major oil companies, the universals as they call them, or which means that they go, the vertically integrated oil companies. Their credit spreads and equities, yes, they all move together. But of course, they all have their own exposure. For example, Shell has had let's just say, a long, contentious relationship with Nigeria and their attempt to exit from Nigeria. So every company is going to have company-specific drivers on the price. But we live in such a liquidity-driven world that flow does happen to get spread out across sectors in somewhat of a pro rata basis. So when somebody makes, let's say, Here's a good example. Take it down to a smaller level of allocation. So take it out of the billions. But let's say an entrepreneur sells his company for $100 million. He's been building it for 5-10 years, sells it for $100 million. I have a close friend who works private wealth at one of these large shops. He sees a lot of clients like this. They come in, they have their 100 million, it's fresh capital for them, and they're ready to allocate for the future of their family and generations to come because they've made this generational wealth in all in one moment, but culmination of a lifetime of work. They take this capital and the professionals allocate it for them. Never in that type of scenario is the individual to say, hey, I want 2% of my portfolio in energy equities, right? Let's say we're going to go 50% equities. Of that 50% equities, 2% of it is going to be in energy. So basically 4% of my equity portfolio. Never, never is the client or the manager going to suggest, hey, but let's take all 4% of that and put it in Chevron because I like their projects more than Shell and British Petroleum and ExxonMobil. It would never happen, Demian. So from that perspective, you have to assume that the allocation of new capital does get distributed pro rata against every asset in the world. And sometimes it's more stocks than bonds. Sometimes it's more bonds than stocks. Sometimes it's more treasuries than credit. Sometimes it's more credit than treasuries. But everybody is going to go get a few treasury bills and a little bit of ExxonMobil and this and that. And they do it all through these mostly passive, sometimes active funds. But even the active ones are diversified to some degree. So with the whole financial infrastructure set up like this, what you get is a passive addition to flow across the entire asset spectrum. And now what we have with Bitcoin public companies, Bitcoin Treasury public companies, is a way, and this is what we've talked about with the ETFs when we did in our recent episode, and I used this pipes and buckets analogy with liquidity. You have the pipes all connected now to buy physical Bitcoin through these corporate treasury strategies. And that is the key. Yes, it's company by company on how it's going to perform individually, but broadly, you are seeing new capital get allocated to Bitcoin. And the companies that are the best will get the most capital, and the companies that the worst will fall out of the index or never make it into the index, so they'll never get the flow. We talk about the victories of strategy making it into the S&P 500. It's just the flow aspect of it. You see, if they're in the index, they get the flow. That random entrepreneur that just cashed in 100 million, he is a buyer of Bitcoin through the S&P 500, through the strategy equity, and he doesn't even choose it. That's why Bitcoin is positioned to win as we speak today. It is, and by Bitcoin, I mean the Bitcoin price in a land of 21 million maximum coins. Bitcoin wins because it's scarce and the flow is ready to go. And not every asset class can respond like this to truly limit its supply in the presence of more demand. Gold is more so designed to do this, and the reason I believe it's performing so well is that some of the structural shorts in the market are getting exposed for being unfunded. We've talked about the commercial short covering in gold, and I would love for you, Damian, to do some research on the history of the gold price suppression scheme dating back to the 1980s and understanding how the bullion banks have used paper instruments to short the gold market structurally. And Bitcoin, I was asked in person over the last couple weeks a couple times, what do you think about paper shorts in Bitcoin, and can it fall victim to price suppression the same way that gold had for many years? Of course, the answer is yes, it can, but Bitcoin is better positioned to fight it because of the blockchain and settlement. And that when a company decides to buy, they have to source the coins from somewhere. And they have to prove in some way to their shareholders that they have sourced those coins. So those are some of the things I'm thinking about on Bitcoin corporate treasury strategies and the wave of adoption. The flow is serious and something people have to take seriously. We have Bitcoin essentially at its all-time high as we speak, near 109, 110,000 as of this recording. And that is in part function of what we are seeing.
What I've really wanted to ask you and get at is I saw that Moody's downgraded the US's debt ranking, which is pretty serious because now it's three credit agencies and the US lost its perfect score. So I'm wondering, does this change the flow at all? Are we going to see less money in going into treasuries? I'm wondering if we're going to see it go into Bitcoin more, which is really what I'm trying to get at.
Yeah. So I want to make sure that we don't rush to, or that we don't use the headlines as the driver of our analysis, but that we use price and we use flow. And the Treasury market at $37 trillion is so massive that all talks of weakness of that market are a function of really current and future supply, not really demand. The demand, think about how much demand there has to be to absorb trillions of new net securities every year. An insane amount of demand without the price just collapsing. And our treasury price is collapsing. Well, the last time I looked at yields, they're around their average levels from the last couple years, except for certain parts of the yield curve, notably the very, very long end. So the price hasn't fallen since the downgrade too much, right? Okay, that's the first takeaway. So always look at the price. So where yields? Yields have been trading in the mid fours for quite some time. I'm just looking at the chart here. And 10-year yields at about 4.5%, Damian, are at the midpoint for the last 2 years. And that's the zoomed out lens that I want you to see things through. As someone that is producing research for us at TBL, yes, we love to read what's going on, and the downgrade is a good headline grabber. But then we go to the price and we really look, hey, how did the yield respond to today's news? How did it respond in the 5 to 7 business days after? And how is the rest of the market performing? Because we know that the Treasury market is a condition on the rest of the financial markets, on risk markets, right? And so the Treasury market is performing okay, then the risk markets can perform okay. And if it's not, the risk markets are going to have a tough time. And that's really the lens that I want you to see things through is that we look at Treasury prices and we go from there. Now, your question, what you're trying to get at, and I think it's it's so understandable for me, for you as a student, and for other Bitcoin people, viewers of this show, to think, hey, the US Treasury just got downgraded again by another rating agency. So that means that the broad investing public will not allocate as much to treasuries as they once did, and maybe some of that money will find its way into Bitcoin. Right? That's your question. I understand it. I sympathize with it.
Mhm.
But I cannot agree with that progression of logic. It doesn't sit well with me, because how is more money coming into Bitcoin right now? These corporate treasury strategies are taking off in public equity. That money that's going into strategy securities and other securities that are buying, it's not coming mostly from treasuries. It's coming from other risk investments. It's also coming from new credit creation, brand new money. It doesn't really come from existing money. The higher that US interest rates go and the more unruly that they rise in terms of yield, the worse risk is going to perform. And actually, in that type of environment, Bitcoin is not going to perform very well. And I can tell you that based off of 1 year in particular, and that's 2022. We saw Bitcoin perform extremely poorly in the rapid and unruly rise of treasury yields. What Bitcoin actually needs is a stable financial system with credit growth, not an unruly rise in treasury yields due to a fall in trust of the buyer of treasury debt. It's a different way to frame Bitcoin versus treasuries and this sovereign debt bubble narrative that is out there. I have a big problem with the sovereign debt bubble being ascribed to the US today. I'm not saying it's in a great fiscal situation. The US has a real problem in terms of total interest payments versus its tax revenue. It's eating away. But there's so much debt out there that relies on the US Treasury market to continue to be stable. And if it's not, you get a whole host of things blowing up before any Bitcoin savior bid. In fact, we have not seen the Bitcoin savior bid in that type of environment. We haven't seen it. So let's observe markets. We use TBL liquidity as our model. When TBL liquidity goes up, Bitcoin goes up, which means when rates go down, bond volatility falls and the dollar falls, Bitcoin does well. We've empirically proved that to ourselves, and that's what we need to base our analysis in.
I'm kind of curious. So I know Bitcoin is a risk asset, and that's why when there are high treasury rates, people would rather just go into those because those are risk free. How does gold perform when rates are high?
So gold performs the best historically during times in which real rates are very low. So what that means is when the reward for holding treasuries, given where inflation is, when that spread is low, that's called the real rate of interest, is the nominal yield versus the inflation. When that real rate is very low, gold performs well. And when it rises, gold doesn't perform well because real rates are basically high real rates are a reward to hold treasuries. They make holding treasuries attractive because you're actually getting leftover yield after inflation. And so real yields are historically a great driver of gold. Now, I believe that post 2008 and even post Russia, that gold has separated itself and even elevated itself into its own category, meaning that correlations are falling. Historical correlations are falling. And that would be another way to describe what we are calling the global monetary reordering, in which we are replacing an existing system that relies on foreigners holding U.S. treasuries as the reserve asset. So while it's a good thing that foreigners stack U.S. treasury debt, it's a good thing for the United States to have that demand abroad. The fact that it's good for the United States to have demand abroad, that is separate from this idea that the Bretton Woods Agreement, or the modern version of it, in which it's more like the petrodollar agreement. It's that Saudi agreement. That original 1980s Saudi agreement, 1970s, 1980s agreement that Saudi would sell all of its oil in dollars. We would buy the oil from them in dollars. They would take the dollars and buy U.S. treasuries. That the dollars themselves that are sent out of the country would be used for U.S. treasuries. That is the system of the modern day Bretton Woods, with not gold, but U.S. treasuries as the layer one asset. So the current arrangement is being dismantled. And that means that the U.S. Treasury security, we as the United States, we feel now politically that it's a better idea for us to be less reliant on that system. So what we see now is a move away from treasuries. And so people might think, oh, that will be bad for the treasury market. And yes, losing a source of demand is a bad thing for the treasury market, but it can't just be thought of in isolation. It has to be thought of in a strategic move to reduce the reliance on this phenomenon. And so in that transition to a more stable U.S. Treasury market, from the perspective of the U.S. Treasury and its reliance on foreign buyers and petrodollar recycling, that in that move, we are reintroducing gold as an instrument that you should hold your reserves in. And so that's what we should be thinking about for gold, not really how does gold respond to treasury liquidity. Because I do believe it's separating itself, Demian. It's becoming its own market. And so what we saw with the rise in gold in the recent charge to 3,500, that rapid rise to 3,500 was really not sponsored by any particular treasury market activity, but rather looking at the dollar, looking at the Chinese yuan, looking at the euro. And so old gold correlations are breaking down, new ones are coming up. And I believe that that's because we are in a new monetary system and we're in that progression toward it. Bitcoin going up amid all of this activity is what you and I as analysts are thinking of as highly suspicious. It's highly suspicious in that you might assume, based on the price, that Bitcoin is also part of this conversation. That, hey, use gold, use Bitcoin, don't use US Treasuries. And you would think that that would mean Treasury prices down, gold prices up, Treasury prices down, Bitcoin prices up. But that's not really what the numbers are telling us. So it doesn't necessarily mean that it's an outflow-inflow thing, but more of a restructuring. It makes it difficult for us to analyze, but this is my challenge to you and Augustine in your quantitative crunching. Start looking at those correlations more closely. Look at our correlation matrix that we use, where we line up gold and yields and Bitcoin and stocks, 2-year yields, 10-year yields, real yields, right? Real yields are reflected in tips. That is the real yield. So we have market real yields. We have market nominal yields. We have currencies. Do your own correlation matrix and see, and then just look at the matrix and then look at the time series on anything that stands out. Hey, why is this one high? Let's look back. Okay, cross-asset correlation study is central to everything that I have ever done in global macro. I'm being very frank with you. My first trading strategy ever, I was thinking about this recently. My first trading strategy ever was trading Euro Yen cross versus risk. And I think I understand more today about the structure of that trade than I ever have. It's the carry trade. Borrow cheap and invest with yield. And that flow drives risk also. That's an ancient trade that, I was thinking about recently, because just goes to show you that cross-asset correlation and how these things move in relation to each other, that's all I've ever known, actually. It's all I've ever known. So it is all I'm interested in. And I'd love to do full episodes on correlation with you, Demian. Thank you guys for sticking with us once again at the Bitcoin Layer. With Demian Schott, I'm Nick Bhatia. Make sure to go to thebitcoinlayer.com/subscribe and consider becoming a TBL Pro for the next level of quantitative research surrounding Bitcoin and global macro. We'll catch you guys next time.